How you doing? I'm Big D. Welcome to the show. I do appreciate you stopping in. What I'd like to talk to you about today is silver prices, and possibly what is going to happen in the future. Nobody really knows, but some of the things that are going on are pointing a finger of what direction we're going in. Now, before I came on, about an hour ago, silver prices hit over $97 an ounce. Those echoes of a system that pretty much died this afternoon. What matters right now, what determines whether you have wealth or whether you have nothing, or whether you're solvent or whether you're bankrupt, is the infrastructure of the market itself. It is the plumbing. It is the unspoken agreement that allows trade happen. Now, as of this afternoon, the infrastructure has officially snapped. The infrastructure as a whole, we've been talking about for quite some time now. The plumbing has its issues as well. We are declaring a liquidity freeze in the United States wholesale silver market. For a few years now, I've been talking about this, but I've only been on YouTube for so long. But I've been talking about this on a different platform for quite a few years. I've been warning about the shortage. I've been warning about how low the inventory is in the Comex and the LBMA and in Shanghai. But what happened today is not a shortage. A shortage implies that the market is working, but there just isn't enough product. What is happening today is a system failure. It is more or less a cardiac failure trading mechanism that supports the entire Western precious metals industry. We have just received internal trade sheets, me and my helpful individual who remains nameless. They like to stay behind the scenes. From one of the major authorized purchasers of the United States Mint. Now, for those of you who may not know how this industry works, let me explain. At the bottom, you have the retail investors, which are you and me. Above us, you have local coin shops. Above them, you have online bullion dealers. But at the very top of the food chain, sitting right next to the government itself, are the authorized purchasers. These are the massive wholesalers. These are the companies with the billion-dollar credit lines. These are the only entities allowed to buy directly from the U.S. Mint. They are the heart of the market. They pump the silver blood into the veins in the economy. Usually, every morning about 8 o'clock, they send out a trade sheet to their network. This sheet is more or less like a menu. It lists thousands of products. It lists American Silver Eagles, Canadian Maples, bars, different types of bars that you can buy. And next to every product, there are two numbers, a bid price, and they will pay in what they will pay you, and an asking price, what they will sell to you. Now that sheet is the proof that the market is alive. It is the proof that liquidity exists. Today, the menu is blank. I'm looking at the sheet, and I'm trying to decipher. And the status I am seeing, which I'm seeing is very terrifying. On the sell side, the column that tells you the dealers what they can buy for their customers. The status is uniform. It is a wall of red text. Sold out. American Eagles, gone. Not available. Back order date, unknown. Generic Buffalo rounds, 100 industrial bars, gone. They're literally not accepting orders for a single physical silver product. The shelves are shelves at the wholesale level are not just empty, they have been stripped to bare metal. If a local coin shop calls his wholesaler today and says, I have a customer with $1 million cash who wants to buy some silver, the wholesaler has to say, I cannot help you. The metal does not exist. Shortage means demand is high. The scary part, the part that signals a total collapse of the trading mechanism, is the buy side. Usually, if a dealer is sold out, if they are desperate for product, they will scream for inventory. They will raise their bid price. They will tell the market, we will pay $2 over spot. We will pay $5 over spot. Just bring us the metal. This is how a healthy market responds to a shortage. High prices cure low supply, but not today. Today, we're witnessing an anomaly that shouldn't be mathematically possible. The status on the buy side, the price they will pay you for the silver, is no bid. Let's think about that. No bid. The major wholesalers have stopped buying back metal. They have turned off the buy button. If you drove a chaotic, an armored truck to their loading dock right now, filled with 10,000 ounces of pristine silver bars, they would not open the gate. They wouldn't even let you in. They would not make you an offer. They would turn you away. They would say, we cannot buy this. We do not want it. How is that possible? How can a business be sold out, desperate for a product to sell, and no bid? Refusing to buy product at the exact same time. It sounds like a paradox. It sounds like insanity. If you have customers waving cash at you, why wouldn't you buy the metal to sell to them? Because this is not a supply crisis anymore. This is a capital crisis. This is a liquidity depth spiral. It's not that they don't want the metal. They're desperate for the metal. Their businesses depend on it, having the metal. It's that they don't have the money to pay for it. The wholesalers are maxed out. Their bank accounts are frozen. Their credit lines are trapped to absolute limits. Their cash flow has evaporated. They're sitting in empty warehouses, paralyzed, unable to stock and unable to trade. They are solvent on paper. They might have assets, but they are dead in the water because they have no liquidity. This literally cannot write the check to buy the silver. This is the moment where the market ceases to be a market. A market requires two things, a buyer and a seller. Right now in the United States wholesale sector, we have neither. We have sellers, you, who can't find a buyer. And we have buyers, customers, who can't find a seller. The middleman, the bridge that connects the two, has collapsed into the ocean. The engine has seized, the oil run dry. You've heard the whole scenarios before. And when the wholesale market freezes, the entire supply chain freezes in. The local coin shop cannot restock, so they close their doors. The online dealer cannot hedge their positions, so they widen their spread to 50%, or they shut down the website. The liquidity vanishes. You might be asking, how did this happen? How did the biggest, most capitalized companies in the industry run out of money during the greatest silver boom in history? Shouldn't they be rich? Shouldn't they be swimming in profits and money? This is the cruel irony of the financial system. The very mechanism that uses the product themselves is the mechanism that is killing them. The product they use to insure their business against a crash is the very weapon that they destroy them in the boom. Do you understand? To understand this disaster, to understand why $95 silver, $97 today, is a death sentence for the dealers, you have to look at the hedge. You have to look at the trap that they built for themselves using the Comex. We need to peel back the curtain on the dirty secret of the bullion industry. We need to explain the margin call nightmare that is currently draining every dollar of liquidity out of the United States. We need to explain why the banks are calling in their loans. Let's look at the mechanics of the collapse. Let's look at the success that has become failure. You're probably sitting there scratching your head. You're probably looking at a silver price hovering around $95, $97, fluctuating up and down. Very volatile metal, silver is. And then you say, wait a minute. If these dealers have warehouses full of silver and the price just quadrupled, shouldn't they be popping champagne corks? Shouldn't they be buying islands in the Caribbean? Is it a logical question? If you own an asset and that asset goes to the moon, you get rich. That is how it works for you. At least you think. That's how it would work for a stacker. But that's not how it works for the wholesaler. And this is a dirty secret of the bullion industry that nobody talks about. This is the mechanism that has turned the greatest bull market in history into a funeral for the very people who built the market. You have to understand that a bullion dealer, wholesale bullion dealer, is not a speculator. They are not gambling on the price of silver going up or down. They are a logistics company. They are a moving company. Their business model is simple. They buy a bar of silver spot plus $1, and they sell it to a coin shop for a spot plus $2. They make their money on the spread. They make their money on the volume. They do not care if silver is $20 or $200. They just want to move the metal, but to run a business like that, to hold $50 million of inventory in a warehouse without going bankrupt if the price drops, they have to protect themselves. They have to insure their inventory. And how do they do that? They use the Comex. They use the futures market. Every time a market wholesaler buys 1,000 ounces of physical silver to put on their shelves, they immediately turn around and sell 1,000 ounces of paper silver on the Comex. Why do they do this? Because it makes them market neutral. If the price of silver drops by $10, they lose $10 on the physical bar in their vault. But they make $10 on the short position, and the two cancel each other out. They're safe. It allows them to sleep at night. It allows them to get massive loans from the banks because the bank sees that the inventory is hedged. It works beautifully in a flat market. It works beautifully in a bear market. But in a violent, vertical, explosive bull market, it is a suicide mission. Let's do the math of the disaster that is happening right now. Imagine a dealer bought a million ounces of silver back when the price was $25. They paid $25 million for the metal and to hedge it. They sold short on the Comex at $25. Everything is fine. The bank is happy. But then Venezuela raid happened. Then the China panic happened. Then the U.S. government buy program happened. And the price of silver rocketed to $95 to $97. That's how it's been bouncing around today. Now look at the dealer's balance sheet. On the asset side, they look like geniuses. Their physical silver is now worth $95 million. they have a massive paper gain. But look at the liability side. They are short at $25. The market is at $95. They're losing $70 on a single ounce they hedged. This is a paper loss of $70 million. In theory, it still balances out. The asset covers the liability, and they're still neutral. But there is one difference, one fatal difference that kills companies: cash flow. The physical silver is the warehouse, does not pay you cash until you sell. You sell it. It just sits there. But the short position on the Comex, the exchange does not wait. The exchange demand cash every single night. It is called a margin call. When the price goes up a dollar, the dealer has to wire $1 million in cash to the exchange. By the next morning, to keep the position open, when the price goes up $70, they have to wire $70 million cash. Not silver, not promises. Cold hard fiat currency. Where does a dealer get $70 million in cash overnight? They don't have it in the bank. Their money is tied up in metal, so they borrow it. They have revolving credit lines with the big banks, like bullion banks like JP Morgan, Bank of America, HSBC. These credit lines are designed to handle normal volatility. But this is not normal volatility. This is a hyperinflationary event. The price move has been so violent and so fast that it is burning through the credit lines. The dealers have borrowed every single penny the banks will lend them to pay for the margin calls. They have maxed out the credit cards, and now the bank has called and said, no more. The bank has said, we will not lend you any dollars. You're too leveraged or too risky. This is the liquidity freeze. The dealer is sitting on a mountain of silver worth hundreds of millions of dollars. They are technically rich, but they are cash poor. They just cannot sell the silver fast enough to raise the cash to pay the margin. And because they have maxed out their credit lines, they cannot buy new silver. If you walk in with your silver to sell them, they need cash to pay you. But all their cash is going to the Comex. All their cash is going to satisfy the margin clerk at the exchange. They literally do not have the liquidity to write a check for $5,000. So they put up the no bid sign. They shut down the buying desk. They freeze operations. It is the ultimate irony. They bet on the dollar. They use the dollar system, the futures market, to protect themselves. And now the collapse of the dollar, which is driving the price of silver up, is destroying the dollar-based hedge that holds their business together. They are chained to a sinking ship. The physical market wants to fly, but the paper anchor is dragging them down to the bottom of the ocean. And do not think for a second that the banks will save them. The banks, JP Morgan and the rest, are the ones collecting the margin calls. They're the ones on the other side of the trade. JP Morgan is long, the dealers are short. JP Morgan is draining the dealers dry. They are taking their cash, and soon they will take their inventory. When a dealer defaults, when they can't make the margin call, the bank seizes the collateral. The bank sends trucks to the warehouse and takes the physical silver. This is consolidation. This is a takeover. So the United States wholesale market is currently in a state of suspended animation. The lights are on, but nobody's home. The computer says sold out because if they sell the metal, they have to unwind the hedge and they don't have the cash to realize the loss. The computer says no bid because they don't have the credit to buy. It is a deadlock. And while the United States is paralyzed by the financial engineering disaster that they created, while New York is choking on its paper derivatives, and I'm glad for that. I'm done with this fake lies, fake paper, silver, derivatives, futures. They've been manipulating the price of silver forever. Now, the rest of the world is not waiting. The rest of the world does not hedge. The rest of the world deals in cash and carry. And there is one country that has kind of understanding what position the United States is in. There's one country that sees the paralysis in the West and sees it's an opportunity for the century. We need to turn our eyes to the East. We need to talk about India. They're buying up everything they can get their hands on. Because while the U.S. dealers are starting at their margin calls, the Indian dealers are starting at a record price of $113, and they're turning on a vacuum cleaner. Now let's see what a real market looks like. The center of gravity for the global silver market has violently shifted. It has moved 5,000 miles to the east. It has landed in Mumbai. And if you want to know what real price of silver is, if you want to know what a free market looks like, when the paper shackles are removed, you need to look at the multi-commodity exchange in India, the MCX. Because right now, India is not just participating in the market, India is conquering it. We have just received data, the closing data from India's trading session, and the numbers are absolutely historic. The price of silver on the MCX has shattered every previous record. It has hit $113.88 per ounce. That is just mind-boggling, because that's going to hurt the United States more than anybody has any idea, and it might shut them down even further. Now, that is the wholesale benchmark price for the for a bar of silver. If you convert the local currency, the rupee, at the current exchange rate, they're paying 335,521 rupees per kilogram. That is a number that would have sounded like science fiction 6 months ago. Now remember, June of 2025, an ounce of silver was only like right around $30. Like I said today, it bounced over $97. But today it is the reality on the ground. Now compared to the number flashing on your screen, if you're looking at what's going on in America and the price, India's $113 is definitely much bigger than the 97 when it bounced over $97. Usually silver flows from the mines in Mexico to the vaults in London and New York. That is the traditional route. But today, that route has been pretty much hijacked. Why would a refiner in Switzerland sell a bar to New York? They would pay them 95 when they can put it on a plane and go to Mumbai and get 113. They wouldn't. They're capitalists. They follow the profit. The United States is being drained. The United Kingdom is being drained as well. We are witnessing a massive physical flight. The metal is leaving the West, where it is treated as a paper gambling chip, and it is going to the East, where it is treated as money. And the reason for this panic in India is specific. It is urgent, rumored to have been swirling in the Delhi and Mumbai for the past 48 hours, and that the Indian government is about to slap a massive import tariff on silver to protect the rupee. The Indian people know their government. They know that when the government threatens attacks, they do it overnight. So the people are front running the ban. They are panic buying. It is a stampede. Housewives are buying jewelry. Farmers are buying ankles. um, Businesses are buying bars. It is not speculative buying. It is cultural buying. It is a wealth preservation buying. And unlike the Americans who buy paper ETFs, the Indians buy the real thing. And that's what I suggest you buy. Real silver. If you don't own it, if it's not in your possession, you don't own it. If it's a piece of paper and it says you have something, something happens in New York uh, at the Comex and it totally shut down, you have no idea what's going to happen, if you'll ever get your money back or the real price of silver when it does go crazy. Now they take delivery, they hold it. This $18 premium is the death knell for the Comex. You cannot maintain a paper price of $95 when the physical market is trading 20% higher. The arbitrage is too powerful. Traders, the smart ones who still have credit lines, are buying the cheaper paper contracts in New York, demanding delivery and shipping the metal to India. They are stripping the Comex to feed the MCX. This is why the wholesale market is in the United States is broken. The US dealers cannot compete. They cannot pay $113 because their customers in Ohio won't pay it. So the metal bypassing America completely. The US has become a flyover state for the global silver trade. The metal flies over New York and lands in Mumbai. And this creates a feedback loop. As the metal leaves the West, the shortage in New York gets worse. The sold out signs we talked about in part one are getting more permanent. There's no bid liquidity crisis. It gets deeper because there is no metal flowing back into the system to replenish the liquidity. It is a one-way street. India buys, the West bleeds. And while the Indians are sucking the physical market dry, something extremely disturbing is happening in the papers casino that is supposed to regulate all of this. Something that changed in the behavior of the big banks on the future exchange for weeks. They were playing games. They were rolling their position. They were kicking the can down the street, but nowadays the music stopped. The game changed. We need to look at the Comex deliveries. We need to look at the February contracts because the data shows that the banks have stopped rolling and started taking. They know that India is doing what India is doing, and they are preparing for the vault to empty. Let me get to the data. Let's see who is standing for delivery. While the rest of the world is contracted, while the wholesale dealers are freezing and India is burning hot, the most telling signal of all is coming from one place that usually lies to us. It is coming from the belly of the beast. It is coming from the Comex futures market in New York. For the last 3 weeks, we have watched the banks play a very specific game. It is called rolling. They were talking their positions in the spot month, January, and they're frantically rolling them forward to March and May. They were kicking the can down the road. They were saying, we don't want the metal now. We will deal with it later. They were desperate to avoid delivery. They were desperate to keep the paper game going. But on today, the music stopped. Excuse me. And the rolling stopped. The taking began, and they have just analyzed the data, and it's shifting the behavior, undeniable. Instead of pushing contracts into the future, the bank suddenly decided to stand their ground and demand the metal now. The total deliveries for the January contract, a contract that I remind you is supposed to be a non-delay ghost town, have now exploded to 42.65 million ounces. Let's put a number in the perspective. 42 million. In a normal January, you might see 2 or 3 million. We are witnessing a 2,000% increase in physical demand during the quietest time of the year. This is not a trading anomaly. This is a bank run. The entities hold the contracts, looked at the $18 spread in India. They looked at the sold out signs in the U.S. Mint, and they said, I am not waiting for March. Give me my bars today. And who is leading this charge? Who is the one entity that seems to know exactly what is going on? We have to look at the issues and stops report from today. There were 243 delivery notices issued. That means 243 contracts that were put up for settlement. And guess who stepped in to catch them? JP Morgan. Out of 243 notices, the house account of JP Morgan stopped, which means they took possession of 176 contracts. That is 72% of the total daily volume. JP Morgan is cleaning up the floor. They're acting like a vacuum cleaner inside the vault. Why would they do this? Why would they take massive deliveries in January instead of rolling to March? Because it could be a lot more money for silver, right? Because they see the same thing we see. They see the liquidity freeze in the wholesale market. They see the India is sucking metal out of London. They know that if they wait until March, the metal might not be there. It might be in Mumbai. It might be in a solar panel factory somewhere. Could be China, could be India. So they grab it now. They're securing the physical asset before the system completely locks up. And the danger is not over because January is ending. We're now looking at the February contracts. February is another non-delivery month. It is supposed to be empty, but the open interest, the number of contracts still open and active, is showing a potential demand for more than 11 million ounces. 11 million. Now, if those contract holders stand for delivery next week, and why wouldn't they? With India paying $113 per ounce, it will break the back of the available inventory. We're looking at back-to-back months of record draining. The pause that the banks were hoping for, the breathing room that they usually get in the winter, has been canceled. The drain is accelerating. This is the sign of the market that hosts faith in the future. And healthy market traders are happy to hold contracts for future deliveries. They trust the system. In a dying market, nobody wants a promise. Everybody wants possession. The fact that rolling has stopped means that the trust has evaporated. The banks are essentially saying, I don't trust you to have this silver in March. I want it in my truck by Friday. This is the psychology of the run. And it connects perfectly to the liquidity freeze we are talking about today. The dealers are freezing because they are short. Their banks are taking delivery because they are long. Now the capital is moving from weak hands, the hedge dealers, to the strong hands, the vault of JP Morgan and the Indians. It is a consolidation of wealth on a scale we have never seen. But here is the tragedy. Here is the cruel twist of fate that makes this situation so desperate for the American industry. The entire U.S. precious metal sector, the dealers, the wholesalers, the logistics companies, is failing. Not because they were wrong about silver. They're failing because they were wrong about the dollar. They tried their fate in a dying currency. They used a dollar-based system to ensure their real world assets, and now the dollar is dragging them down into the abyss. We need to explain this systemic irony, and we need to explain why being market neutral in a hyperinflationary collapse is actually a death sentence. Let's look at the trap. Let's explain why industry is dying while the asset is thriving. This is a cruel, dark irony sitting in the heart of this crisis. If you wrote this as a movie script, Hollywood would reject it for being too tragic. We are watching the total collapse of the United States precious metals industry. The dealers, the wholesalers, the logistics networks, and it's happening for the exact opposite reason why you would expect. Usually when an industry fails, it is because nobody wants their product. Blockbuster failed because nobody wanted to rent a DVD. But the silver industry, they're failing because everybody wants their product. They're failing because the price of the product has skyrocketed. And the reason they're failing reveals a fundamental flaw in the entire Western financial architect. It reveals the fake mistake that every major dealer in America made. They tried to build a business based on sound money, gold and silver, but that built the foundation on fiat money, the dollar. We have to look at the philosophy of the hedge again. When a dealer shorts the Comex to protect their inventory, what are they actually doing? Mathematically, they're betting that the dollar and silver will stay in equilibrium. They are using the paper derivative, which is a creature of the dollar system, to ensure the physical metal. They effectively tied their lifeboat to the Titanic. They thought the chain would keep them steady. They thought the chain was safety. But now the Titanic is sinking. The dollar is collapsing, and because the dollar is collapsing, the price of silver explodes to $97. And that chain, that perfect hedge, it is dragging the lifeboat down with the ship. This is the margin call we talked about earlier. The margin call is simply the cost of betting on the dollar. Every time the dealer has to wire cash to JP Morgan to cover their short positions, they are paying a penalty for trusting the fiat system. They are bleeding capital because they refuse to hold the metal naked. They were too scared of volatility. They were too scared of price dropping. They were insured, so they insured themselves against the drop, but they never insured themselves against the melt up. They never insured themselves against the dollar dying, and now they're the victim of their own prudence. And there is another layer to this disaster. It is called capital intensity. Back when silver was $25 an ounce, a wholesaler with $10 million credit line would move 400,000 ounces of metal at a time. They could run a massive business on a relatively small amount of credit. But today, with silver at $97, that same $10 million credit line only buys, say, 100,000 ounces. Their purchasing power has collapsed by 75%. The price of metal has gone up, but the bank's willingness to lend it is not. Now, the banks are not giving them 4 times the credit just because silver is 4 times the price. The banks are giving them less credit because they see the volatility. So the dealers are facing unprecedented financial limitations. That is the polite corporate term for we are broke. They literally cannot afford to run their businesses at these prices. Silver has become too expensive for the middleman to handle. It is like a gas station that can't afford to buy gasoline to fill the tanks because oil hit $500 a barrel. The gas station goes out of business even though everyone needs gas. The silver dealer goes out of business even though everyone needs silver. This is why the buy button is turned off. This is why no bid sign is up. They're suffocating from a lack of working capital, and this creates the ultimate misalignment of interests. Right now, you, the stacker, the investor, you're cheering for silver to go to $150, $200, $300, $400, whatever you're cheering for. You want the moon, but your dealer, the guy you buy from, he is secretly paying or praying for a crash. He is praying for silver to go back to $50. So his margin call stops, so his capital goes further, and so he can breathe again. The industry is at a war with its own customer base. The rising price is enriching the holder but destroying the distributor. This is the end of just-in-time model. The model that relied on cheap credit, stable prices, infinite paper hedging is dead. I cannot survive in a hyperinflationary environment. And as these U.S. dealers fail, as they hit their credit limits and freeze operations, they leave a vacuum. They leave a hole in the market where the supply used to be. And we know now that who fills that vacuum. We know who steps in when the weak hands fold. India steps in. China steps in. JP Morgan steps in. The entities with the real capital. The entities that don't need to hedge because they actually want the metal. And they're going to take over. We are watching the transfer of the silver market from paper hands of the Western dealers to the diamond hands in the Eastern orders. So where does this leave you? It leaves you standing in front of the broken machines. It leaves you holding fiat currency in a world where the people who sell real assets can no longer accept your money. The wholesale market hasn't just paused, it has died. And we need to accept the reality of the verdict. We need to summarize what happens next, because if you think you can just wait for things to normalize, you have mistaken. This is the new normal. The freeze is permanent. This is what I believe. Let's wrap this up. Okay. Let's look at the final verdict. So here's the verdict. We have looked at the trade sheets. We have seen the sold out signs on the sell side, and there's no bid signs on the buy side. We have looked at the record-breaking $113 in India for an ounce of silver. We have looked at the internal collapse of the U.S. wholesale dealers network, which is currently suffocating under the weight of its own debt and margin calls. The diagnosis is not complicated, it is terminal. The United States physical silver market, is currently in a state of cardiac arrest. The heart has stopped beating, the blood has stopped flowing. We are looking at a market that is technically open but functionally dead. You have understanding the gravity of what no bid means. It means that the liquidity and the ability to turn your asset back into cash instantly has evaporated. It means that if you're holding silver in the United States right now, you're holding an asset that is disconnected from the local financial system. You cannot sell it to your local wholesaler because they have no money. And if you have tried this, let me know in the comment section if you're able to buy and sell in your local area. And now you cannot buy it from them because they have no metal. The bridge is out. The only way to cross the river is to go over the bridge, and you're still standing. And the bridge in Mumbai, now that bridge in Shanghai, now this brings us to the most important realization you need to make today. The price you see $97 on the Comex. Now completely irrelevant. It is more or less a zombie price. It is a price that exists only in a computer simulation where infinite leverage and infinite paper promises still work. But in the real world, the world where you need physical metal to build a solar panel or protect your wealth, that price is a lie. The real price is $113. The real price is whatever the Indian housewife is willing to pay to secure her family's future. And the gap between the zombie price and the real price and the cost of the collapse of the Western trading infrastructure. We are witnessing the end of an era. For 50 years, London, New York dictated the price of silver of the world. They used to use their paper derivatives to control the physical today and the reality. Today, that control has officially been broken. The West has run out of physical metal, and now it has run out of the credit needed to pretend otherwise. The scepter has been passed. The East is now the captain of the ship. India is setting the price. China is setting the floor. And the United States is just bystanding, watching on its own. So what is your move? If you are holding paper, if you are holding an ETF or an allocated pool account, you're standing in the middle of the liquidity freeze. You're holding a claim on a dealer that might be bankrupted by Friday. You're holding a promise from a system that has already defaulted on its own logistics. I would, if it was me, I'm not telling you what to do, I would get out. If you can still redeem for physical, do it. If you can't, realize that your paper position is a trap. And if you are holding physical silver, do not sell it. I would not recommend selling it, but this is all up to you. Read my disclaimer in the description below. Do not let a desperate dealer talk you into selling at $95 so they can survive another day. Do not throw your life raft to a drowning bank. Your silver is the only thing that is real. The wholesale market has died so that the true market can finally be born. The manipulation is over because the manipulators are broke. This is the reset. The sold out sign is permanent. The no bid in the silence before the scream. The Western system is finished. The market is dead. Long live the price. And I do want to say thank you for stopping in. I appreciate everybody who stops in and watches these shows. Please subscribe. Get my subscription up. I'm trying to build this show, and everything you do for me, I do appreciate it. If you leave a comment, I'll leave a comment for you. And smash that like button. That would be great. Try to have a great rest of your day. God bless. Bless your family. Have a wonderful afternoon.